Good evening, students. Welcome to the session. So, today we are going to discuss the statutory update and the judicial update, which are applicable for your attempt. Also, we'll quickly go through what are we have obviously looked into the amendments while we were revising each chapter, while the lectures were taken for each chapter. So, we have looked into the amendments, but we'll quickly go through, some of the important amendments that were there. Just, have like a final recap of all the amendments which are there for your attempt besides these circulars or notification. But the first thing that we will focus on is the notification and circular, and then the judicial update, and then after that, whatever time permits within that, we will be going through all the like Finance Act 2024 amendments which have been there for your attempt, which are applicable. Fine, because FA 2025 is not applicable for your attempt. So let us just quickly start with it. So these are the list of circular and notifications which are applicable for your specific attempt. So first, as under the capital gain. Now under the capital gain, there has been this one notification which is issued for the purposes of section 54 EC. What is section 54 EC, students? Very quickly. Yes, what is 54 EC? Yes. What is 54 EC? Very fast. Yes. 54 EC, students, provides for an exemption in respect of capital gains, isn't it? Wherein if you sell the land or building or both and you invest the amount in the specified bonds, right, within the period of 6 months from the date of transfer. Yes, Samnathan. So in that particular case, you can get the exemption from the capital gain. Now, what are the specified bonds which are listed for as the specified bonds for the purposes of 54 EC? Yes, what are the specified bonds that you have been looking till now? You're not revising. NHAI, RECL, yes. IRC, PFC, yes. Very good, Samnithan. So, Rural Electrification Corporation Limited bonds, National Highways Authority of India bonds, bonds of Power Finance Corporation, Indian Railway Finance Corporation. These are the 4 bonds which were listed. Now, the central government has also notified how the exam gives you that the amount of the consideration has been invested in HUDCO bonds. Then please pay attention that it is a notified bond for the purposes of 54 EC. So which are the bonds? NHAI, RECL, PFC, IRFC, and the HUDCO. Please do not miss that. They will not say that, you have to claim 54 EC. You have to apply your own mind and say that, okay, HUDCO is a specified bond for the purposes of 54 EC. What is the maximum investment that you can make in the asset, in the specified bond? Yes, 50 lakh. Very good, Samnithan. So we need to invest up to only, the exemption is available only up to 50 lakh. Fine. The next is under the TDS. What are the circulars which are issued under the TDS? So in respect of the TDS, the payments which are made to the specified units in IFSC. In that regard, the central government has issued a notification that no tax is required to be deducted in respect of the payments, the specified payments made by any payer to a unit of IFSC. Why is it so? When there is a unit of IFSC, what does it claim as a deduction? Yes. Unit of IFSC is eligible to claim which kind of deduction, students? ATLA, isn't it? They claim ATLA deduction, right? So, since their profits are allowed as a deduction. Yes, Leela. Not 10 double A, Leela, ATLA. So when their profits are allowed as deduction, so therefore any payments made to them should also not be subject to the TDS. So what are the payments that they have given? So in case a payee is IFSC banking unit, so payer can be anybody. It is about the payee. If the payee is the IFSC banking unit, if it receives interest income on the ECBs or loans, professional fees on which TDS is subject under 194J, referral fees under 194H, brokerage on 194H, commission income on factoring and forfeiting services under 194H. On all these payments, there is no TDS required. Are we clear? IFSC Intermediary Insurance Office. So if the payee is the IFSC Insurance Office, if it receives the insurance commission, it should not be subject to TDS under 194D. If the payee is the IFSC Finance Company and if it receives the interest income on ECBs or loans, which is subject to TDS under 195 or 194A, or the dividend income under 194, or commission income on factoring and forfeiting services, there is no TDS required. Again, the same is for the finance unit, IFSC finance unit. Then if it is a IFSC fund management entity, if it receives a professional fee, there should not be any TDS under 194J. If there's an IFSC broker dealer and if it receives a dividend income, there should not be any TDS under 194. If there is an IFSC investment advisor and if it receives the investment advisory fee, there should not be any TDS under 194J. If there is an IFSC registered distributor and if it receives the distribution and commission fee, there should not be TDS under 194H. If there is an IFSC custodian and if it receives a professional fee or commission fee, there should not be TDS under 194J or 194H. And if there is a credit rating agency which receives the credit rating fee, again there should not be any TDS under 194J. If there is an IFSC investment banker and if it receives the investment banker fee, again no TDS under 194J. If there is IFSC debenture trustee and receives a trusteeship fee, again no TDS under 194J. If there is International Trade Finance Service or ITFS in IFSC and if it receives the commission income, no TDS under 194H. If there is a fintech entity in IFSC which receives either the technical fee or professional fee or commission income, there should not be any TDS under 194J or H. However, these payee have to furnish a statement cum declaration to the payer containing the details of the previous year in respect of the 10 assessment year for which it is claiming the deduction under ATLA. Are we clear? And for those years only for which it is claiming the deduction under ATLA, the payer would not deduct the tax on such payments made to the payee once it receives the statement cum declaration and furnish the particulars of all the payments made to the payee on which the tax has not been deducted in view of this notification. So remember, this is not available for all the 10 years, but only for the years where ATLA has been opted. Are we clear? Yes, okay. Next is applicability of the exemption under section 10.15.8 to interest paid by the IFSC banking unit. So, in respect of the interest paid by the IFSC banking unit, right, on the deposits kept by the non-resident or RNOR, or on borrowings from a non-resident or a RNOR, that will be exemption under section 10.15.8. So if you know that the interest on the deposits, bank deposits also paid to the non-resident external account are exempt, right? So it says that in respect of this, the CBDT has clarified that even the tax will not be required to be deducted on interest paid by the IFSC banking units Either they are, even if they are the branches of Indian banks or they are the branches of the foreign bank, right? On the interest paid on these deposits or on the borrowings from the non-resident or the RN1. Are we clear? Yes or no? Any questions, any doubt? Okay. Then non-applicability of TDS under 194N on the cash withdrawals by the specified person. What is 194N, students? What is 194N? Yes, Samnathan, greater than 1 crore TDS. Suchita, TDS on cash withdrawal. Yes, is it 1 crore, 2 crore or 3 crore? Ruchita, yes, 1 crore. It's not 2 crore. So 194N requires the bank, cooperative bank or a post office to deduct the TDS on the cash withdrawal more than 1 crore by any person or 3 crores by a cooperative society. What is the rate of TDS? 2%. Yes, Samnathan, very good. Right? So there has been now a notification issued by the central government in respect of which 194N shall not apply. So it says that 194N shall not be applicable to the foreign representations duly approved by Ministry of External Affairs, which is foreign representations like the diplomatic missions, agencies of the United Nations, international organization, consulate and offices of the honorary councils, which are exempt from paying the taxes in India. Are we clear? Next is the notification with respect to the person on whom tax is required, no tax is required to be deducted. So, if the payments are received by the Credit Guarantee Fund Trust for Micro and Small Enterprises, National Credit Guarantee Trustee Company, which is established by the central government for the purposes of operating the credit guarantee funds. Credit Guarantee Fund established by the central government and managed by the National Credit Guarantee Trustee Company Limited. In these cases, the payments made to them are not required to be subject to TDS. Further, again, with respect to the unit of the IFSC, no TDS is required to be deducted under 194Q also. So the above notification was with respect to the 194J, H, C or 194D, right? Commission, Insurance Commission. This is with respect to 194Q. What is 194Q, students? Purchase of goods. TDS on purchase of goods. So even when you purchase the goods from IFSC unit, there is no TDS to be required to be deducted if the seller furnishes a statement cum declaration for the years in which it is claiming ATLA deduction, and for those years the buyer would not be required to deduct the TDS. It has to just furnish the information in its return that the TDS has not been deducted in view of this notification. Next is the central government has issued a notification for the purposes of that who will not be required to collect the TCS under 206C1H. What is 206C1H? Yes. Collection of TCS on what? Yes, Suchita. TCS on sale of goods above 50 lakh. Yes, Samnathan. Very good. So here they have said that the unit of IFSC shall not be considered as a buyer for the purposes of 206C1H. So 194Q is also not applicable. If the seller is unit of IFSC, 2060 1H will also not be applicable if buyer is the unit of IFSC. Here, the buyer has to just furnish a statement cum declaration with respect to the years in which it is claiming the ATLA, and the seller would not deduct the TDS for those particular years. Okay. Next is the waiver of levy of interest under 2011A or 2067 in specified cases. So 2011A is what? What is 2011A? Failure to deduct or pay the TDS. Yes. And what is 2067? Failure to pay or collect the TCS. Right? So in these cases, the interest is levied. In these cases, the interest is levied on account of this failure. Now, what happens is that many times the payment is made on the due date. However, the payment doesn't happen on the due date to the government account because of some technical glitch. Let's say the bank portal has not, been working properly, because of which my account has been debited, but the payment has not gone to the central government. And in those cases also, the interest has been levied. So the CBDT has directed the Chief Commissioner of Income Tax or the Director General of Income Tax to reduce or waive the interest where the payment has been initiated by the taxpayers or deductors or collectors, and the amounts were debited from their bank account before the due date. However, the tax was not credited to the account of the central government before the due date because of some technical glitch beyond the control of the taxpayer or deductor or collector. And the Chief Commissioner, Principal Chief Commissioner or the DGIT may examine the application for waiver of interest and pass a speaking order after providing the opportunity of being heard to the applicant and after verification of the technical glitches from the bank or the Directorate of System. And if the assessee or the taxpayer or the deductor or collector has already paid any interest, the same can still be waived and a refund can be given to the deductor if the waiver is ordered. However, the waiver application has to be made within the 1 year from the end of the financial year in which the interest is charged under 2011A or 2067. And the PCIT, CCIT or DGIT shall waive the application, dispose of the application within a period of 6 months from the month in which the application is received. Are we clear? Yes? Any question? Okay? Fine. Next is for the assessment procedures. Now, there is section 139AA. What is 139AA, students? Aadhaar. What Aadhaar, Samnithan? Aadhaar not to be quoted. It is Aadhaar to be quoted, right? So 139AA mandates that every person who is eligible to obtain the Aadhaar is mandatorily required to quote the Aadhaar number in the application form of the PAN and also in the return of income. Yes, if you do not quote the Aadhaar, then what happens? Yes. No, it will be treated as that you do not have obtained like a PAN. So then, 206 AA will be applicable. All of those, penal provisions will be applicable to you. So here, if a person does not have Aadhaar, he is required to quote his enrollment ID of Aadhaar application. So enrollment ID is given at the time of application form, right? So when you have applied, so enrollment ID of Aadhaar application form has to be quoted if he does not have the Aadhaar at the time of enrollment in the application or in the return of income. However, after 1st October 2024, the option of quoting the enrollment ID of Aadhaar for the allotment of PAN or in the return of income is discontinued. So, every person who has now been allotted the PAN and who is eligible to obtain Aadhaar has to intimate his Aadhaar number only. And if any person has been allotted PAN on the basis of enrollment ID of Aadhaar before 1st October 2024, has to intimate his Aadhaar number to the authorities. So central government has notified that every person who has been allotted PAN on the basis of enrollment ID of Aadhaar application has to intimate his Aadhaar number to the Principal Director General of Income Tax before 31st December 2025. If they do not, then it will be deemed like that the PAN is not applied. Okay. Next is provision in respect of the compounding of offences. So there has been an FAQ issued in respect of that and the guidelines issued for the compounding of offence. What do we mean by compounding of offence, students? What is compounding of offence? What do we mean by compounding of offence? Prosecution will apply? No. No, that's not right. When offender voluntarily accept no, Ruchita. Compounding of offence means penalty in lieu of the prosecution. So penalty shall be levied instead of undergoing the prosecution. So section 279 of the income tax provides that before or after the institution of proceedings, the prosecution proceedings, these may be compounded by the principal chief commissioner, principal director general or director general of income tax to compound the offence. Now the CBDT has issued the guidelines for compounding of offence. Okay. So what are the specific guidelines which are there? So first is that these guidelines have been issued from the 17th October 2024 and applies to all the compounding applications filed after this date as well as filed before this date but which were pending and not yet disposed of. So it is not that, the applications that were pending before these guidelines have to be again filed afresh. It's not like that. These guidelines will be applying automatically. However, in case under earlier guidelines, if any applications were rejected on some, defects which were there, like, non-payment of tax, interest, penalty, or filing of application in incorrect form, mentioning incorrect assessment year or financial year, or incorrect section under which offence has been committed, non-payment or short payment of compounding charges, non-submission of withdrawal of appeals undertaking. So on these curable defects, the application can be filed again in respect of the new compounding guidelines. However, if the applications have been rejected on merit, then under the new guidelines, the application cannot be filed again. So if the application has been earlier rejected on the ground of any, like you do not have any merits in the application, then you cannot apply again. However, if the application has been rejected on some, curable defects, then the applicant can reapply under the revised guidelines. What are the conditions for the compounding application? So the condition are that the application has to be first made to the jurisdictional principal chief commissioner, CCIT, DGIT or principal DGIT. And the compounding application may be filed for offence pertaining to one financial year in case of the assessee, or in case of the TDS offences, it has to be filed for 1 quarter or for multiple years or multiple quarters. So if you file for multiple years or multiple quarters, it may be called as a consolidated compounding application. Are we clear? Now, whether the applicant can withdraw a compounding application and file a new application. So the applicant can file a new single or consolidated application after withdrawal of the earlier application. However, it will be treated as a subsequent application and not a new application. And whether if the applicant has committed 2-3 offences, does he have to apply for each of the offence or all the offences together? So the applicant can apply for multiple offences in one single application. He doesn't have to apply for each offence separately. Are we clear? And is there any limitation as to the number of times he can go for compounding? There is no limitation. However, the application can get rejected because the authorities may feel that he is a habitual offender. Now, what is the time limit for filing the application? So, the application, either single or consolidated, may be filed at any time after the offence is committed. It can also be filed after the prosecution proceedings have been launched. Regardless of whether the offence has come to the notice of department or not. What is the compounding fee? The applicant has to first deposit a non-refundable compounding application fee of 25,000 for a single compounding application and 50,000 for a consolidated compounding application. This is non-refundable fee, but it will be adjustable against any compounding charges which will be decided. So this is first only the application fee that we are talking about. The compounding charges will be separate. Okay. So this is a non-refundable fee first which is going to be there. Of course, this can be adjusted against the compounding charges. However, this is non-refundable. You cannot get the refund back. This cannot be adjusted against the any other compounding fees that you pay again in a separate application. Okay. So if an application gets rejected, you will not get the refund of it, nor it will be adjusted against in a subsequent application. And if any application gets rejected, whether separate application need to be filed for more than one application rejected. So an applicant may apply for compounding of offence through a single consolidated application if his applications have been rejected under the previous guidelines. So it is not that again, he has to apply every new application again and again. He can file a consolidated one even in that case. Then he has to pay. So first is he has to apply to the PCIT, CCIT or DGIT or principal DGIT. He has to file at any time, even after the institution of the proceedings. There is no problem within that. He has to pay a compounding application fee of 25,000 for single or 50,000 for consolidated application. He has to pay all the outstanding tax, interest, penalty or any other sum due relating to the offence for all the relevant years, and in case of the TDS default for all the quarters for which the compounding has been sought before even he makes the compounding application. If any demand is outstanding which the department finds, the same will be intimated to the applicant. Within 30 days of the intimation, he has to pay that amount. So within 30 days, maximum 3 months, he has to pay that. Otherwise, the compounding application shall not be considered. So the compounding application is valid only when you fulfill all these conditions. Secondly, he has to give an undertaking that he has paid the compounding charges. He will pay the compounding charges within the stipulated time frame. Compounding charges, I told you, are different from compounding application fee. Although application fee can be adjusted against compounding charges. And he has to withdraw the appeals. He has to give an undertaking to withdraw the appeals, if any, related to the offences which are filed by him. Okay. And in case the appeal has been filed on multiple grounds, one of the ground is an offence which he has committed for which he is coming for compounding, then he will withdraw that particular ground itself. Are we clear? So he doesn't have to withdraw the appeal before coming for compounding. He has to just give an undertaking to withdraw, including any writ petitions. What are the conditions? Can anybody repeat? Yes. What are the conditions for compounding? Yes. What are the conditions we just now discussed?
Ma'am,
Yes.
he has to pay the fees, compounding fees, 25,000 or 50,000 consolidated के लिए. फिर he has to pay the compounding charges. फिर any tax due, he has to pay any tax due or within intimation of 30 days, tax or any penalty interest, and he has to undertake uh, uh, he has to undertake any appeal file.
He has to give an undertaking to withdraw the appeal.
Yes, withdraw to, yes, okay.
Yeah, he has to give an undertaking to withdraw the appeal. He has to give an undertaking to pay the compounding charges.
Yes,
Are we
ma'am.
clear?
Yes.
Yes. Okay. So these are yes, Samnithan, very good. So these are the conditions. Now, in case if you do not pay the tax, interest, penalty, or you do not file in a correct pro forma, or you do not put the correct financial year or assessment year or the correct section number, the application will be regarded as the defective. However, these applications can still be revived without payment of additional compounding application fee of 25 or 50,000, provided that the defects are cured within a period of 1 month from the date of intimation of defect. In case the defect is not cured within the time allowed, then the application will be returned back to the applicant and he will have to again file the application. Now, there are certain offences which can be only compounded with the approval of the higher authority. What are these offences? So these offences can be compounded with the only approval of chairman of CBDT, not directly by CCIT, PCIT or DGIT or PDGIT. What are these offences? In case of an offence for which the applicant has been convicted with the imprisonment for 2 years or more with or without fine by a court of law. In case of an offence which is related to another offence under any other law for which he has been convicted with imprisonment for 2 years or more with or without fine by the court of law. If the applicant, as per the information on the basis of investigation conducted by central or state agency, has been found to be involved in any anti-national or terrorist activity. So in that case, again, the chairman of CBDT also has to consult with the relevant agency and seek their input regarding the activity and its implication for the purpose of deciding the compounding application. In case the applicant is a person other than the main accused who has facilitated the tax evasion through mechanisms such as use of entities for money laundering, generation of bogus invoices of sale or purchase without actual business, providing accommodation entry. If the offence is related to the black money law, provision of Benami property transactions, or if the offence is under 275A and 275B of the Income Tax Act. So in these particular cases, the application cannot be directly undertaken by the prescribed authorities. They have to be taken by the approval after taking the approval of the chairman of CBDT. So which are these particular application? Where he has been already convicted for imprisonment of 2 years under either income tax or under any other law by a court. If he has been involved in some terrorist activity or anti-national activity, if he has been facilitating tax evasion, accommodation entry, bogus invoices, any offence relating to black money law, provision of Benami Property Transaction Act, or any offence which is relating to the search. Okay. So, when an offence has been of these nature, then these can only be applied with the, these can only be compounded with the approval of the chairman of CBDT. Otherwise, all other offences can be compounded by the authorities that we discussed. Are we clear? Fine. Now, what is the compounding procedure? So, once the application has been submitted along with the application charges, right, and all these undertakings, the competent authority, who is the competent authority? PCIT, CCIT, PDGIT or DGIT, the jurisdictional one. They will obtain a report from the assessing officer or assistant or deputy director who will submit the report to the competent authority. And if the application is not found to be acceptable, then they will dispose of the application through an order within 2 months from the month of receipt of application. However, if the application is acceptable, then they will intimate the applicant that these are the compounding charges which are payable, and if there is any tax due, interest or penalty due, they will also give that. And this will be issued within 2 months from the date of receipt of application. And they will require him to pay within 1 month the compounding charges. This time limit of 1 month can be extended in exceptional circumstances up to 6 months if the request has been given by the applicant. It can also be extended up to another 12 months with the prior approval of the Principal Chief Commissioner of Income Tax. Can be extended beyond 12 months and up to 24 months with the permission of the chairman of CBDT. However, no extension shall be allowed after 24 months. So the maximum extension to pay the compounding charges can be 24 months in very, very high cases. And if the compounding charges are not paid within the time limit permitted, then the application will be rejected and the prosecution proceedings will be initiated. Are we clear? Yes? Sorry, I think my network was weak. Yeah. So if the compounding charges are not paid, the application will get rejected. And the complainant shall serve a copy of prosecution to each accused within 15 days of filing the complaint. Are we clear? Now, what is the time to pass the compounding order? When the applicant pays the compounding charges, the competent authority then shall pass the compounding order within 1 month of the payment of compounding charges. And in case the proceedings to impose penalty are pending at the time of filing of the compounding application, such proceedings will also get concluded and the demand related to penalty if any, will be recovered before issuing the compounding order. Are we clear? And in the compounding order, it will be clearly written that it is intended to resolve the offense and should not be construed as an admission of the offense. Now, why is this important? Because, particularly the taxpayers have a notion, have a misconception that if we, go for compounding, they will think that we have accepted the offense. This is not the acceptance of offense. This is just to buy the peace of mind. So this is not to be construed as an admission of offense, but the resolution of the offense. Are we clear? Any questions till now? Yes? Any doubt? Any questions? Is this clear, students, to everyone? Yes or no? Okay. So what are the prescribed authorities that we discussed so far? Yes. What are the prescribed authorities that we discussed so far? Yes. Application can be made to which prescribed authority, students? What did we discuss? Yes, students, faster. Which are the authorities for the compounding? Yes, Leela, very good. PCCIT, CIT, DGIT, PDGIT. Very good. Okay. Now, compounding charges. So, how the compounding charges will be calculated? So, the compounding charges for the first compounding application or the consolidated compounding application has to be computed for each offense. And any subsequent application shall be counted as a second, third, and fourth compounding application. So, if a person has applied for a compounding of an offense, so the compounding charges for the subsequent application shall be 1.2 times, 1.4 times for the third, and 1.6 times for the next one, and so on. So if you have already compounded first application, and if let's say there were some defects and you did not rectify the defects within 30 days, so then it's a subsequent application. So subsequent application, the charges will be 1.2 times of the earlier. Are we getting this point? So if the applications are rejected, then it is, if you do not rectify the defect within 13 days, it is treated as a subsequent application. And if the application is made beyond the 12 months from the month in which the prosecution complaint is filed, the compounding charges shall be increased by 50%. So these are the, no, Samnithan, application fee is different. As I told you, fee is different. That is just a non-refundable fee. These are the compounding charges. These are the compounding charges which are there. Are we getting this? There's a difference between the two. Yes? These are different. Okay? So, if you file the first application, that is one. Then if you file any subsequent application, that is will be considered as a subsequent application. Or if you do not rectify the defects within the period of 30 days. Okay? Or if, let's say, for example, if the application was filed earlier and now it is withdrawn, and if there were some partial compounding charges were paid for that application, can it be adjusted against the new application? So partial compounding charges which are paid for the earlier application which is now withdrawn, cannot be adjusted. It can be adjusted in the new application only towards a particular year or particular offense for which it was made. Are we clear? And if any application was rejected prior to these guidelines, then if it was made for some curable defects like tax interest not paid, form not correct, then in that particular case it will be considered as a first application. However, if it is rejected on merits, then in that case it cannot be considered. Are we clear? Then it will be considered as a second application. Any questions, any doubt? Okay, so this is the illustration of how the compounding charges will be calculated. So let's say this is on 15th January 2021. This is compounded. This offense pertains to 276B 1230. Now, this is the first application. Okay. 17th October 2022. This is again compounded. This is in respect of 276C to 1890. This is 18th August 2023. This is rejected under 276B. This is 17th September 2024. This is pending. This is under 276D. Now, these were prior to the issuance of the guidelines. The guidelines were issued in 2024 October. Now, these applications have already been done. This is pending. So, this will be considered as first or the subsequent application. This will be considered as first application. And no fresh application is required because this is pending. Now, this will be treated under the new guidelines. Now, a single application is made for earlier rejected application of this 276B. This will be considered as a second application. Are we getting this point? So this will be considered as a second application. And the rate will be 1.2 times of the normal rate. Now again, a consolidated application is filed under December of 276B for another year. Now this will be considered as a third application. Are we getting this point? And the rate will be 1.4 times of the normal rate. Then again 276C for another year. So now this application which is there for 276C, the first one was filed in the prior guidelines. Now this is being filed now. So this is now in respect of this offense, this is the second application. And for 275A, this will be considered as the first application. So you have to see each offense wise. Are we getting this particular point? So for 276B, it was one application which was already done prior to the guideline. So that is also considered as the first application. Okay. Now, the second application is considered after the guidelines. So even if you have done prior, that is still fine. Are we clear? Yes, there is a question. What is it? Since there are working once more because of that additional fee are charging? Yes. Okay. So even if you have applied for an offense prior to the guideline, this new application that you will make for that same section, that will be considered as a subsequent application. Are we clear? Any questions, any doubt? Yes. And if the application has been filed after 12 months of the prosecution, then the compounding charges shall be increased by 50%. So let's say, for example, the assessee has made the TDS default of 10 lakh rupees for 3 months during the financial year 1920. The prosecution has been launched on 1/4/2022 under 276B. Now the normal compounding charges are, let's say, 45,000. So scenario 1, the application is not rejected earlier, any application. In the first case, the date of application is 12/10/2022, which is pending as on 17/10/2024. The time from the launch of the prosecution is less than 12 months and the compounding charges will be 45,000 normal. This is the first application. Case 2. The application is filed on 31st October 2024, which is more than 12 months. So you will increase the charges by 50%. So this will be 1.5 into 45,000, 67,500. Scenario 2. The first application which was filed on October 2022 has been rejected and now I am filing under the revised guidelines on 31st/10/2024. So this was less than 12 months, but this was rejected. Now this is more than 12 months. So what I will do is 1.2 times, because this is subsequent application, plus 50%. So 1.2 into 45,000 into 1.5, 81,000 will be charged. Are we getting this, students? Yes? Yes or no? Are we getting this particular thing? Is this well understood by everyone? Yes? Okay. Last point in this, where the offense has been committed by a company or a HUF, an application for compounding may be filed either by the company or HUF or along with the person who is deemed to be guilty of the offense, which are referred to as co-accused. So either they can file a combined application for the compounding or they can file a joint application along with the directors or the members of the HUF. So they can file a joint application as well. So any of the co-accused also is eligible to file the compounding application. However, if any application has been rejected earlier, then in that case, it will be treated as a subsequent application. Are we clear? Yes or no? Any doubt, any question with respect to the compounding together? Yes? And in the case where they file a combined application, the charges also will be one. It will not be treated. It will be like for an offense, the compounding charges. It will not be, for them separately. Yes or no? Yes, there's a question. Ma'am, in case of more than 12 months, we need to increase by 50%. Yes, that's right, Ruchita. Yes? Okay. So let us move forward then. Next is the amendment in the Form 3CD. What is Form 3CD, students? What is Form 3CD? Tax audit. Very good. What are the amendments? In the Form 3CD, now it has been, a column has been added or a portion has been added for the amount of interest inadmissible under Section 23 of MSME Act. What is this? Can anybody explain me what is this? What is this basically? Payment to be done within 15 days. Yes, Samnithan. If agreement, 45 days. Yes, very good. So, if you know, Section 43B requires you to make the payment to MSME within the due date of the agreement. If there is That is, if there's no agreement, within 15 days. If there's an agreement, maximum within 45 days. Or the time period stated in agreement. And if you do not pay within that time frame, the payment will be allowed in the year when you actually make the payment, right? So for that purpose, a clause has been added, clause 22 has been added in the MSM, in the tax audit form 3CD, which asks you that what is the amount of interest inadmissible under section 23 of MSME Act, and what is the total amount which was required to be paid to the MSME during the previous year, and what is the amount paid up to that time, and the amount which is not paid up to that 15 or 45 days. So you have to first state the total amount which are paid to the MSME. Then what is the amount paid actually within that time limit, and what is paid beyond the time limit. So under clause 22, a disclosure has to be made which should include the amount required to be paid to all the MSME, including the amounts which are not claimed as a deduction in the P&L, irrespective of whether they have been paid during the year or whether they are outstanding on the balance sheet date. So here the reporting should include all the amounts which will have accrued during the year but are not due for payment as on 31st March. Because this asks you the total amount required to be paid to MSME. It doesn't say what is the amount paid, it says the total amount required to be paid to a MSME. So here the reporting should include all the amounts. And then you need to give a breakup of the total amount which is required to be paid to MSME, out of which you will make the payment, out of which the payment which have been actually made within that time limit, and the payment which has not been made within the time limit, which will attract the disallowance under 43B, which have been claimed as deduction or which are outstanding as on the previous year and which have not been paid within that time. Are we clear? So this is the reporting which is required under the clause 22 of the 3CD. Next is clause 26 of 3CD. In respect of any sum referred to in 43B, the liability for which pre-existed on the first day of the previous year, like there was an opening liability, but was not allowable in the assessment year in that particular previous year itself, as it was paid during the previous year or it was not paid during the previous year. And secondly, was incurred in the previous year and was paid on or before the due date for furnishing the return of income, or was not paid before the due date. So basically what they are trying to say is that in case there is some opening liability which was there as per your books, let's say for example you had the liability of PF, employer contribution. Now whether this has been paid before the due date of filing of return of income or it was not paid, and therefore it will be allowed in this year. Are we getting this? So if any sum was not allowed in the preceding previous year because of section 43B, can be allowed in this year on the payment basis. Because the amounts were not paid till the due date of return of income of that previous year. So here what you have to include is the amounts which were outstanding as on the first day, and see whether they have been inadmissible during the previous year, and if they are same paid during this year, it should be reported, and if it is not paid, it should be reported in B. And in the next year, the tax auditor should again check the amount reported in clause 26A, that the amount was reported as inadmissible earlier, and here in this year they have been paid. Are we clear? Then there has been changed in clause 31 of 3CD. Particular of the loan or deposit exceeding the limit taken in section 269 SS. What is 269 SS? What is 269 SS? Yes, loan deposit exceeding 20,000 in cash. Very good. So here they have included one particular row, amount of loan or deposit taken or accepted and the code of the nature of such amount. So clause 31 asks you the particular of each loan or deposit exceeding 269 SS limit, which is 20,000. And you have to give the particulars of now any specified sum taken in relation to the transfer of an immovable property. So that has to be now given. And it asks you the information also in respect of all the repayments made by the assessee of any loan or deposit or any advance in an amount exceeding the limit specified in the 269T. So each transaction, individual transaction has to be reported separately, even if it is from the same person. And what is the nature of each transaction, whether it is a loan, whether it is deposit, whether it is in relation to transfer of immovable property. So what are the nature of amount or receipt or payment which are given? Cash payment, cash receipt, payment through the non-account pay check, receipt through the non-account pay check, transfer of asset, transfer of liability, conversion of assets, conversion of liability, journal entries, any other mode. So this all has been given in this particular clause. So this is for both 269 SS and 269T. 269T is what? Repayment. Okay. So they are asking for both this under 31. Under 31A, they are asking each loan or deposit exceeding the specified limit, which is accepted during the year. Are we clear? And in the clause C, they are asking particulars of each repayment of loan exceeding the limit specified in 269T. Okay. Then there is clause 36B, which is asking whether the assessee has received any amount for buyback of shares as referred to in 222F. Are we getting this particular point? So 222F is what? What is 222F? Yes. What is 222F? Buyback of shares, not assessee in default, Samnithan. Buyback of shares considered as deemed dividend. Yes. Yes, Suchita. So, in case of buyback of shares, we have now 222F, which is there, right? So, this has been newly introduced. So, clause 36B asks us whether the assessee has received any amount for buyback of shares. If yes, furnish the amount received and the cost of acquisition. So, earlier it was taxable under the capital gain. Now it has been taxable under the dividend. So, the tax auditor should look at that what is the amount of buyback which is there after 1st October 2024. So before 1st October 2024, if there has been any buyback, it should not be reported here. And this should be verified with the TIS or the AIS, wherein the company would report it and deduct the TDS also. And what is the actual cost incurred? Are we clear? So this is 36B which has been there. So there are 4 clauses which have undergone change under the tax audit. This can be asked in the examination also. First is clause 22, which specifically asks you the amount of interest which is inadmissible under section 23 of MSME, or the total amount required to be paid to a MSME, of which what is the amount that you have paid up to the section 15 timeline and what is the amount that you have not paid. Are we getting this particular point? So in this particular case, the tax auditor should identify first of all that who are the MSMEs to which the payments have been made. How do you identify whether a particular entity is MSME or not? Yes, lower limits. Yes, based on the investment. Yes. Yes, Samnathan. So you need to take a certificate on the basis of which you will know what is the turnover, what is the investment in respect of that entity. So what are the criteria for MSME students? It will not cover the medium enterprise. It will only cover the micro and the small enterprise. Yes or no? You have to be careful in the examination, students. Be very, very careful. So, in case the question gives you this particular thing, you have to see what are the criteria which are applicable. So, what are the criteria? Can anybody tell me? Yes. Yes, students, faster. Micro enterprise and the small enterprise. You don't need to consider the medium. Yes, Samnathan. So you need to see whether the turnover is less than 5 crores and the investment in plant and machinery or equipment is less than 1 crore for the micro. For the small, it is less than 10 crore investment in plant and machinery and turnover less than 50 crores. That is the criteria. So only micro and small are considered over here. Are we getting this particular point? Okay. And you need to report here all the amounts first. Whether they have been paid during the year, whether they are outstanding, whether they have been accrued but are not due for payment. All of this. And in the second part, you need to include what has been actually paid to them during the year. Are we getting this? And what has not been paid. Okay. Then in the clause 26, you have to report for 43B for the pre-existing liability, but which was not allowable in the last previous year. It was not allowed in the last previous year because of the amount was not paid in that year. Because it was not paid in that year on account of late payment after the due date of filing of return of income. Okay. Or in the case of MSME, the amount was paid after the due date of MSME Act. So here it will include in the clause 26 all those amounts and which have been paid during the previous year. So if there was outstanding liability which was not allowed in the last year, either because they were paid after the due date of return of income, or in the case of MSME after the section 15 due date. So the tax auditor should check the amounts so reported within the sum as inadmissible in clause 22. So in the last year, you would have disallowed that amount or put under the clause 22. And if the same is paid during the year, it should be reported in that year. Or if it is not paid, then you need to report in the point B. So if for the MSME, if you would have not paid, you would have given over here amount inadmissible in the last year. And this would have been a liability which was, let's say, standing out. So if you have paid that liability during the current year, it will come here. Otherwise, it will come over here. Are we clear? Is this clear? Any doubt, students, with respect to this? Okay. Yes or no? Yes, is this clear? Okay, fine. Ruchita, can I repeat the limit? Certainly, I can repeat the limit for the MSME you want, right? So for the MSME, we need to take the micro and small enterprises. We do not need to take the medium enterprise. So you have to take the micro and small enterprises. You don't need to consider the medium enterprise. And in respect of that, for micro, investment in plant and machinery less than equal to 1 crore and turnover less than equal to 5 crore. For small, investment in plant and machinery less than equal to 10 crore and turnover less than equal to 50 crores. Okay. Then there was a change in clause 31, which is particulars of loan deposit taken exceeding the limit specified in section 269 SS and repayment more than the limit of 269 ST. Are we clear? So that has been under this clause. And last is with respect to the buyback of shares. Next is conditions for non-resident engaged in the business of operation of cruise ships. We did yesterday only. Section 44 BBC. What is section 44 BBC, students? What is 44 BBC? We did yesterday itself. Presumptive. How much is the presumptive rate which has been offered? 7.5%. Yes? 20%? How is it 20%? What is the presumptive rate for the cruise ship? Yes. What is the rate given, students, in the cruise ship presumptive rate 44 BBC? Yes. %, so 20%, 7.5, it's 20. Samnyathan 7.5, yes, is 172 section. 44 BBC, it is 20. Do not get confused there, okay? So, in respect of the cruise ship, 44 BBC is there, and for that purpose, the notification has been issued by the CBDT. What does it say? That the assessee, in order to claim this 44 BBC, should be a non-resident engaged in the business of operation of cruise ship, has to operate a passenger ship having a carrying capacity of more than 200 passengers or a length of 75 meters or more for leisure and recreational purposes and having appropriate dining and cabin facility for passengers. Operate such ship on scheduled voyage or shore excursion touching at least 2 seaports of India or same seaports of India twice. Operate such ship primarily for carrying passengers and not for cargo. Operate such ship as per the procedure of the Ministry of Tourism or Ministry of Shipping. Okay. Then next is submission of statement by a non-resident having a license office. So a non-resident having a license office in India has to prepare and deliver a statement to the AO in respect of the activities carried out by license office. So if you remember, I told you license office is a communication channel between the customers and the head office. So license office is supposed to carry out only those activities, like preliminary activities, not the core business activity, because a license office can only be set up after the approval of the RBI. Because if it is found that license office is actually doing business in India, then its license can get revoked. It will not be considered as a license office. It's like a main operating office. So this has to also deliver a statement to the AO regarding what activities it is actually doing. So the form 49C has been notified to be furnished within 8 months from the end of the financial year. Okay. Now next is the safe harbor rules for determining the arm's length price in respect of the income referred to in section 911. What are safe harbor rules, students? What are safe harbor rules? Have you done this in transfer pricing? Yes. Samnathan, very good. So the safe harbor rules means that the pricing as per the CBDT, if the assessee offers between the associated enterprise, it will be accepted as is. So safe harbor means the circumstances in which the income tax authorities will accept your transfer price if you declare as per their policy. So the CBDT has notified the safe harbor rules for the section 911. What was section 911? What was section 911, students? We discussed that day. Yes, business connection. Yes or no? So if a foreign company is engaged in the business of diamond mining, which has exercised the option of safe harbor rule, this is an optional provision, and which is in the business of selling raw diamonds in a notified special zone, and it has the receipts from the any person from sale of raw diamonds, then these diamonds are either uncut, unpolished, unassorted, unworked, cleaved, not conflict diamonds. Then it can opt for the safe harbor provision. It can exercise the option of going for the safe harbor. And what is the safe harbor provision here? 4% of the gross receipts. So the business profit shall be 4% of the gross receipts. It's just like the presumptive provision itself. And no further deduction, including the depreciation, shall be allowed here. No set off of the UAD or brought forward loss shall be allowed. No set off of loss from other business or under the IFHP shall be allowed against the income and PGBP. And it has to maintain all the books of accounts. Are we clear? Yes. Then this is for the IFSC entity. Not IFSC, the diamond entity. There are also safe harbor rules which are notified with respect to the assessees entering into the international transactions. What are the eligible international transactions for which the safe harbor rules are notified? Provision of software development services. Software development services will include development of software, information system development, support for the existing systems, converting or translating computer languages, debugging of systems, adapting of existing software, preparing user documentation, all of this. Now, what is the safe harbor for them? If the value of the international transaction is less than 100 crores, the operating profit margin that should be declared by the assessee in relation to its expense, operating expense, should not be less than 17%. And where the value of the transaction is more than 100 crore, less than 300 crore, it should not, it should exceed 18%. Are we clear? Then, in respect of provision of ITES, Information Technology Enabled Services, where the value of transaction does not exceed 100 crore, 17%, where it exceeds 100 crore, less than 300 crore, 18%. What is ITES service? Back office operation, call center, contact center services, data processing, data mining, insurance claim, legal database, translation, payroll, remote maintenance, revenue accounting, support center, website services, remote education, clinical database management, all of this. In case it's a provision of knowledge process outsourcing services, which means the outsourcing services performed with respect to the assistance or use of the IT, requiring the application of knowledge and advanced analytical skills like geographic information system, HR services, engineering design, animation content development, business analytics, finance analytics, market research. In those cases, what they have given is that if the value of transaction does not exceed 300 crores, then if the employee cost in relation to operating expenses at least 60%, then the operating margin to the operating expense should be 24%. In case it's more than 40%, less than 60%, the employee cost to operating expense, it should be not less than 21%. And if it does not exceed 14%, it is 18%. Okay. Then in case of intragroup loans, where the loans are given in INR, the interest rate which is given in relation to that international transaction should not be less than 1 year marginal cost of funds, lending rate of SBI plus 1.75% if the credit rating of A is between AAA to A. 3.25% if it is triple B minus, triple B or triple B plus. 4.75% if it is between double B to B. 6.25% if it's C to D. And where no credit rating is available and the loan to A's, including loans to all A's in Indian rupees does not exceed 100 crores. So, in case of intragroup loan or advances which are given by one entity, Indian entity, to an associated enterprise being a non-resident, in that case, it will be the 1 year marginal cost of the SBI lending rate. Plus, based on the credit rating of the A, this percentages will be there. Are we clear? In case of advancing of intragroup loan, where the loan is denominated in foreign currency, then the interest rate shall not be less than the reference rate of the relevant foreign currency as on 30th September. And if the loan is given to an A, which does not exceed 250 crores, it will be added with 1.5% if the credit rating is between this AAA, AA plus, AA minus, A plus, A minus. 3% if it is triple B plus, triple B or BB minus. And 4% if it is in the other category. And if the loan exceeds 250 crores, then these are the percentages which you have to add to the reference rate. 1.5% for AAA, AA plus, AA minus and A plus, A minus. 3% if it is triple B plus, triple B or triple B minus. 4.5% if it's BB plus, BB minus, B plus, B minus. And 6% if it is in the C or D category. If it is providing corporate guarantee means the guarantee which is given by the company to its wholly owned subsidiary, which is a non-resident, in respect of any borrowings which it takes, which can be in the form of letter of comfort, corporate guarantee, performance guarantee. And if the amount guaranteed does not exceed 100 crores, then the commission or the fee in relation to that international transaction should not be at a rate less than 1% on the amount guaranteed. If it exceeds 100 crore and the credit rating of the agency, associated enterprise done by the agency registered with SEBI is of the adequate to the highest safety, then in that case also it should be 1% per annum on the amount guaranteed. In case of the R&D services in relation to software development, where the value of international transaction does not exceed 300 crore, then the operating profit margin to the operating expense should not be less than 24%. What is contract R&D? The R&D services in respect of producing new theorems, algorithms, development of IT, programming languages, communication software, development of information technology, research into the methods of designing the software, software development that produces advanced capturing, transmitting data, experimental development, R&D on software tools and technology, upgradation of existing products where source code has been made available. And in case of the R&D in relation to the pharmaceutical drugs, again, where the value of the international transaction does not exceed 300 crore, it is again 24%. In case of manufacture and export of core auto product components, the operating margin to the operating expense should not be less than 12%. Auto components will be like engine, transmission, steering parts, suspension, brakes, lithium ion batteries. In case of non-core auto components, other than these core components, it should be 8.5%. And in case of low value adding intra-group services, what are low value adding intra-group services? Where the services are given by one company to the another company, which is associated enterprise, which are in the nature of support services, not the core services, which are not, contributing to any profit generating activity, not in the nature of shareholder services, which are not giving rise to any unique intangibles, which are not having any significant risk. So in that particular case, like, R&D services, not in the nature of R&D services, manufacturing, IT, knowledge process, business process, purchasing of raw materials, sales, financial transactions, insurance, it should not be these kind of services. In that case, it should not be the value of the international transaction, including a markup, not exceeding 5% if the value does not exceed 10 crore. Are we clear? Now, this safe harbor rules are applicable to eligible assessee. Eligible assessee is a person who has exercised the option of safe harbor and is engaged either in the process of software development, IT-enabled service, knowledge processing, made the intragroup loans, provided the intragroup guarantee, corporate guarantee, engaged in contract R&D in relation to either software development or pharmaceutical drugs, engaged in manufacture and export of core or non-core auto components, or is in receipt of low value added intragroup services from its group. Are we clear? Yes or no? Okay. Any questions, any doubt? Yes or no, students? Is this clear? Yes? Any questions, students? Okay. So this option provision has to be exercised by furnishing a Form 3CEFA before the due date of furnishing the relevant return of income. And this will apply for a period specified in the form or maximum for a period of 3 years. And the AO shall verify that all your transactions are covered transaction. And based on that, the AO will allow this particular option to be exercised. Are we clear? So this is something, a safe harbor rule that you have to keep in mind. What additional amendments are covered over here? Let us have a look at it. There are 2 more amendments which are covered in this. Yeah. Condition and activities notified for finance company to qualify for exclusion from the applicability of provisions of 94B. What is 94B, students? What is 94B? The restriction on the deduction of interest expense. You will not be allowed the interest expenses, which is how much interest expenses are not allowed? Excess interest expense. But what is excess interest expense? Over and above 30% of EBITDA, isn't it? So a finance company has been located in IFSC has been excluded from the applicability of 94B. Yes, Samyathan. So finance company under the IFSC regulation has been excluded from the purview of 94B. What is a finance company? Finance company is if it does not accept public deposit from residents or non-resident, and it is not registered with the authority as a banking unit. Now, the CBDT has inserted a rule 21 ACA to provide that the finance company located in IFSC shall only carry out these activities: lending of loans, commitments, guarantees, credit enhancements, securitization, financial lease, factoring and forwarding of receivables, functions of global or regional corporate treasury centers such as borrowing, lending, hedging of currency, commodity risk or investments, cash management, structured credit, intragroup financing, financial budgeting or such treasury services. Are we clear? And the interest paid by the borrower in respect of debt issued by a non-resident shall be in foreign currency. Okay, so these are the amendments with respect to the circulars and notifications issued which are applicable for your attempt. So with this, we will take a break, and after the break, we'll move on to the judicial updates. Okay? Okay. Break, please. Manishi? Yeah, break. Okay, students, so we now move towards the judicial update. Let us look at the judicial update. So the first case is the PCIT versus Jupiter Capital Private Limited. Now, what was the question in this case? Here, the reduction of the share capital had taken up. There was no change in the shareholding pattern and the face value of the shares. So whether this will constitute the transfer under 247 in the hands of the shareholder. So what had happened is the company, Jupiter Capital, had reduced the share capital, right, to basically wipe off its losses, because of which, its net worth had got eroded. So as per the High Court's order, it had undertaken a reduction in the share capital from 15 crore shares to 10,000 shares. So the shareholding of the taxpayer was reduced from 15 crore to 10,000. However, the face value of the share had remained the same. They had not changed the face value. So the question is whether this is considered as transfer. So the court in this case observed that the section 247 includes the extinguishment of any right. Now, the extinguishment of any right which is there is a very wide term. It covers every possible transaction which results in the cancellation, cessation, termination of any rights which the assessee has in the capital asset. In this case, the face value has remained the same before the reduction and after the reduction. However, the total number of shares were reduced from 15 crore to 10,000. So on account of the reduction, the assessee's right of those many shares had extinguished. So the assessee's shares were reduced to 10,000. So reduction of a right in capital asset amounts to transfer under 247. So in this particular case, the court held that there is extinguishment of rights and the capital loss arising on the proportionate reduction in the share capital will be allowed to the assessee, even if the overall shareholding in the company remains unchanged. Are we clear? Is this case clear to everyone? Yes? Okay. Fine. Next is Travel Designer India Private Limited Supreme Court judgment. Here the question before the Supreme Court was that the assessee had filed its return of income and the return was found defective, and accordingly an intimation was sent under 143(1) to correct the defects, okay, within the period of 15 days. And these defects were rectified by 19th of July. Subsequently, the AO issued a notice under 143(2). What is 143(2)? A notice for the assessment. The assessee contended that the notice can be issued within 3 months from the end of the financial year in which return is furnished. And thus, the notice was barred by limitation. Why the assessee was saying that is that for the purpose of determining the 3-month period for the 143(2), the relevant date should be the date of the, whether it should be the date of the original return of income or when the date of removal of defects of the return in response to notice issued for the defective return under 139(9). So that was the question before the Supreme Court. So 139(9) provides to the assessee an opportunity to rectify the defects if there are defects identified. And 143(2) says that the AO can issue a scrutiny notice within 3 months from the end of the financial year in which return is filed. Now, since the return was defective, The assessee removed the defects on 19 July 2024. And once the defects are removed, the return goes back to the original due date of filing. So the limitation for issuance of notice under 143(2) is 3 months from the end of the financial year in which return is filed. Here the notice was issued on 11th June 2025. And if the return was filed on 29th November, when does the 3 months expire? 3 months from the end of the financial year, when does it expire, students? Yes. When does the 3 months expire? 30th June 2025? Yes. The financial year ends on March 24. Sorry, March 25. And 3 months from that is June 25. Yes. So 30th June 24. The return was filed in 2023. So the financial year for return was till March 24. And 3 months from the end of the financial year will be June 24. Here the notice has been issued on 11 June 2025, which is much beyond the period of limitation. Therefore, the court held that the notice issued is quashed and set aside. Are we clear? Next is Bank of Rajasthan Limited case of Supreme Court. Here the question before the Supreme Court was whether the interest paid by the bank for broken period on purchase of securities, can it be claimed as revenue expense? What is a broken period? Can anyone tell me? You have learned this in CPT, IPCC. What is a broken period? What is a broken period, students? Yes. So broken period refers to, let's say for example, if I'm purchasing the securities, right? Between the date before which the interest is payable. So let's say for example, the security which is there gives me the interest on monthly basis, let's say on every first of the next month. Now I'm purchasing the security on 15th of, let's say, November. And the next interest is due when? On 1st of December. Right? So in that particular case, what happens is the bank, when on 1st of December, the interest will be payable. Who will get the interest? The bank or the seller? Bank, right? Because the bank is holding as on 1st December. So ideally for the 15 days, the seller held the security. But the entire interest for that 30-day period will be given to whom? To the bank. Isn't this injustice to the seller? He held the security for 15 days and the bank held for another 15 days. But the bank is getting for entire 30 days. So the bank, in addition to the cost of security, has to also pay the interest for those 15 days. Interest accrued to the seller for those 15 days. From the last date of payment of interest till the date of purchase. This interest is known as the interest for the broken period. Is this understood to everyone? Yes or no? Yes, Samyathan. Interest between the two coupon dates. Is this understood to everyone? Yes? Okay. So, whether this is allowed as a revenue expenditure for the bank or whether this is has to be capitalized. So, Here the Supreme Court noted that the banks are required to purchase these securities. This is usually on the government securities because government securities give you this interest coupon. To maintain the statutory liquidity ratio, the bank have to purchase these government securities. And as per the RBI guidelines, the securities are categorized into three categories for the bank: held to maturity, available for sale, and held for trading. If the securities are held as available for sale or held for trading, then these are classified as stock in trade in the books of bank. In that case, if the interest is paid on such securities which are held as stock in trade, it is a revenue expense. However, for the securities held to maturity, which are long-term in nature, because they are held till their maturity for a longer term, this is categorized as a long-term investment in the books of the bank. In that case, the interest will be capitalized. Are we clear? If it is held as stock in trade, it will be allowed as deduction. If it is held for a longer period, then it has to be capitalized. Are we clear, everyone? Is this clear? Yes or no? Yes, okay. Next is Supreme Court decision in the case of Adyan Technologies. What is the question? Whether the expense incurred by the assessee towards the development of software for advertisement, which because of its technological development had to be abandoned, can be claimed as a revenue expenditure. What do you think? Now, the assessee was engaged in the business of internet advertising services and it had to develop its software. It had incurred certain expenditure for development, but it could not be developed because the technology became obsolete. So what do you think? Can it be capitalized or will it be allowed as revenue expenditure? Expense of. The court here noted that here the software being abandoned, there was no enduring benefit which the assessee got and therefore it lost all its money and therefore here this expense will be charged to the revenue. Clear? Last decision is Delhi High Court decision in case of Johnson Matthey Public Limited Company versus CIT International Tax. The question is whether the amount received as a guarantee fee by a foreign company from its Indian subsidiary fall within the definition of interest. Now, how is interest defined under 228A? Interest means interest payable in any manner in respect of any money borrowed or debt incurred, including deposit claim or other similar right or obligation, and includes any service fee or other charge in respect of the money borrowed or debt incurred in respect of any credit facility which has not been utilized. Now, this company was a UK-based company. It was a tax resident of UK. So, India has a DTAA with UK also. So, we look into the definition of interest under the India-UK DTAA as well. Then interest means income from debt claim of every kind, whether or not secured by mortgage, whether or not carrying a right to participate in debtor's profit, in particular income from government securities, income from bonds, debentures, premiums, prices attaching to such securities, bonds or debentures, shall not include any item which is treated as distribution of the dividends. So here the court noted that the interest as defined in treaty and in the 228A of the Act includes basically what? Whether it includes the guarantee fee? Yes. So the court here noted that the amounts which are there, which are paid to be qualified as interest, have to be in the context of the loan. right? Because it says what? Both the places interest in respect of any money borrowed or debt incurred. Here also it says income from debt claim of every kind. So the claim of any kind which is there, debt claim of any kind under treaty, or in this case includes any service fee or other charge in respect of the money borrowed. These terms have to be understood. So interest does not include any payments made to the stranger. It has to be in accordance with the loan contract. This has to be incidental to the loan. Now, assessee here, this UK company had given a guarantee for which it received a guarantee fee. It received a guarantee fee. So the assessee is a stranger to the loan contract. Here, this is a contract of guarantee and not a contract of loan. The contract of loan exists between the Indian company and the bank. So the expression debt claim of any kind in the treaty or the service fee in respect of money borrowed under the Act does not extend to the guarantee commission. The interest is defined to mean amount payable in respect of money borrowed or debt incurred. Here, the Indian company had not borrowed from UK company. So there was no debt between the two. So the income that is received with respect to guarantee fee was in consideration of any guarantee that has been given. So that will be applicable because if, let's say for example, tomorrow Indian company defaults, it will have to pay. So the guarantee fee, High Court held that would not fall under the ambit of either 228A of the Act or under Article 12 of India-UK DTL. Is this clear, students? Yes or no? Any questions? Any doubt? Okay. So now this completes your all the judicial updates as well. So now what are we going to do? Now we are going to discuss, first of all, that what are the applicable amendments to your Finance Act 2024. So as I have told you, Finance Act 2025 is not applicable for your attempt. Okay, so first we are going to discuss the Finance Act 2024 itself. Now under that, tell me what are the tax rates which are applicable to you? What are the tax rates for the individual which are applicable to you? So you are going to revise with me. You are going to give me the answers. What are the tax rates which are applicable for an individual? Yes. Yes, what are the tax rates? Old, new, old, there are no changes. I know that. For the new 115 BAC, you have to give me the answer. Yes, faster. Yes, up to 3 lakhs, it is nil. 3 lakh to 7 lakh, it 5%. And after every 3 lakh, you have to increase by 5%. 7 to 10 lakh, 10%. 10 to 12 lakh, 15%. 12 to 15 lakh, 20%. And over and above 15 lakh, it is 30%. Correct. Right? So that is the tax rate which is applicable for your attempt. The old tax rates remain the same. That is, there is no change in that. Yes? There is no change in respect of that. But in respect of 115 BAC, there has been a change. Okay. So that you have to take into consideration. When you apply 115 BAC, you have to note that, okay, these are the tax rates which are there. Okay. Now coming towards the company. For a small company, which year turnover would you see? For a small company, what is the turnover criteria which you will see and what is the tax rate? Not 440 crores, Geeta. No, not 50 crores, Ruchita. Yes, Geeta, it's 400 crores for the previous year, 21-22. Yes. For which previous year? 21-22, 22-23, or which year? Which year you will see? 22-23. Yes, Leela. Yes, Geeta. Very good. For 22-23, you will see. So if the turnover or gross receipt of the previous year 22-23 does not exceed 400 crore, then what is the tax rate for the company? What is the tax rate for the company? 25%. Yes, Ruchita. Very good. The tax rate is 25%. Okay. So this is what you have to clearly see this in the examination. Don't make a mistake there. Okay. Then, first of all, in respect of section 222F, what is the change? What is the change in respect of 222F? I'm going section number wise. What is the change in 222F? What was it earlier? What is it now? You have to tell me both. Because you need to remember both. What is 222?
Ma'am, buyback of shares.
Very good. Yes. Yes.
Before
Yeah.
before 1st October 2024, company has to pay tax 20%, and under capital gain, shareholder can claim sale consideration minus cost of acquisition. After 1st October 2024, no tax for the company. For shareholder, 222F IFOS, and under capital gain, we have a cost of acquisition loss.
Very good. So, before 1st October 2024, okay, there used to be buyback tax which is applicable. So you need to remember both, okay, because this is in the period of 2024 that, before 1st October and after 1st October. Now, if it is before 1st October, then in respect of the buyback, there used to be a buyback tax under 115QA, which was 20% plus 12% surcharge plus 4% cess, which makes to 23.296%. In the hands of the shareholder, no taxation. The income was exempt. If the buyback is undertaken by a domestic company, there was a tax liability under 115QA on the domestic company itself at the rate of 23.296% on the amount paid, the consideration paid minus the cost of shares. Right? And in the hands of the shareholder, it used to be exempt under 1034A. After 1st October 2024, there is a liability in the hands of the shareholder. The amount received on the buyback is considered as deemed dividend in the hands of the shareholder. And no deduction of expenses will be available against such dividend income. Okay. So in case of a dividend income, no deduction of expenditure shall be allowed. Whether can you claim 20% of interest expense against this buyback dividend? No, we can't claim. Are you understanding this? You can't even claim the interest expenses. Are we getting this? No deduction allowed. The cost of acquisition of such shares will be allowed to you as a capital loss under section 46A. And that you can set off against the long-term or short-term capital loss. Are we clear? Yes or no? Everybody yes? Okay. What is the change with respect to the period of holding of the shares? Or the period of holding of the capital asset? What is the change? Yes. What is the period of holding of listed equity shares? Okay, tell me one by one. What is the period of holding of listed equity shares? Yes, students, what is the period of holding of listed equity shares? 12 months. It is 12 months only. Listed Leela, it is 12 months. It is 12 months before, it is 12 months now. What is the period of holding of listed equity oriented funds? Listed unit of equity oriented fund. 12 months before now, also now 12 months. Okay. What was the period of holding of units of listed units of business trust and what is it now? Listed units of business trust. What was the period of holding? 36 months. Yes, Suchita. Yes, Geeta. Correct. Now it is 12 months. Very good. So, for securities listed in a recognized stock exchange, units of UTI, units of equity oriented funds or units of UTI and zero coupon bond, it was 12 months. Now also it is 12 months. But now it also includes listed units of business trust. Earlier it was 36 months. So you have to remember both. Before 23rd July, it was 36 months. After 23rd July, it is going to be 12 months. For unlisted shares, land or building, it was 24 months. It still remains 24 months. For any other capital asset, what was it? It was earlier, before 23rd July, it used to be 36 months. And now it is 24 months. For any other capital asset, earlier it was before 23rd July, it is 36 months and now it is 24 months. What about the business undertaking, which is transferred in a slump sale? What is the period of holding for it? "36 months. Yes, very good. So, the period of holding for the business undertaking, which has been transferred, was earlier also 36 months. And now also it will be 36 months itself. So only that asset which is there has been for the 36 months. Okay? Fine. Then there has been no change in section 4, section 5, section 6, section 9. No changes in that. Okay? There are no changes in those particular section. Then in respect of the charitable trust, what is the change between the first regime and second regime now? Yes. What is the change in the first regime and second regime under the charitable trust? Yes, Leela, very good. Yes. Yes. No, Geeta, that's not. So, under the charitable trust, what did I tell you while I was teaching you charitable trust? That after the October 2024, no new approvals can be made under 1023C. All the approvals now have to be made under the second regime. Are we getting that particular point? So, now no application for approval or for application for renewal of approval under the first regime can be made on or after 1st October 2024. It has to be made under the second regime. Which are the trusts for which approval was required under the first regime? Yes, annual receipts less than 5 crore is still under the first regime. Yes, Suchita, very good. If it is more than 5 crore for hospital or medical institution or any other institution, now it has to go under the second regime. And educational institution which are existing solely for education, not for profit, and hospitals which are wholly and substantially financed by government, that would still remain under 1023C. Yes? Okay? Any questions? Any doubt? Is this clear for the trust concept? Yes or no, students? Okay. Then, in terms of the approval under 12AB, if you go for that, or the application under 12AB when you submit, there has been a now time limit which has been mentioned for the passing of order by the principal commissioner or the commissioner of income tax. What is the time limit? If it is renewal of the approval or registration, what is the time limit? Or in the case of final registration, 3 months. Yes. 3 months from the, yes. 3 months from the, yes. Yes, Suchita, very good. Yes, okay. So, in case of the renewal of the registration, which have already been registered, it is 6 months from the end of the month and with effect from 1st October 2024 from the end of the quarter. So earlier it used to be 6 months from the end of the month, and from 1st October 2024 it is end of the quarter in which application was received, and in the case of the final registration where the provisional registration has expired. Are we getting this particular point? And in case of the provisional registration, what is there? 1 month from the end of the month. Okay. So, if the application has been made for the renewal or for the final registration, if the provisional registration has expired, it is 6 months from the end of the quarter in which application is received from 1st October 2020. Before that, it was 6 months from the end of the month. And in case of provisional registration, it is 1 month from the end of the month in which the application has been received. Very good, Ruchita. Yes, so you have to remember these points. Are we clear? Then, in case of the exit tax, in case of the exit tax, when is the exit tax applicable? What are the three situations in which exit tax gets applicable?
Ma'am, uh, conversion of a charitable trust into non-charitable trust organization, merger with any
Good.
entity with having no similar object, like 12A, 12AB. Trust does not distribute the asset to any other institution registered under 12AB.
On the dissolution.
Yes, ma'am.
Yeah. So, in the second instance, when the trust merges with another institution, what is the amendment over there? What is the exception to that? Yes. Yes, Geeta. Yes, very good. So, new section 12AC has been inserted to provide where a trust or institution which is either registered under 1023C or 12AB merges with another trust or institution which is not registered under 12AB or 1023C. Exit tax applies, but this would not apply if the other trust has same or similar objective, if it is approved under the first regime or second regime. So in those situations, exit tax doesn't apply. Yes, Kushi, very good. So if it merges with a similar object trust and that trust is registered, then 1023, then exit tax doesn't apply. Are we clear? So three situations in which exit tax apply: conversion into a non-eligible form, merger with a trust which is not having a similar object, and third one is dissolution, but within the 12 months from dissolution, it does not distribute its asset to another registered trust. When it is deemed to be converted into non-eligible form, what are the situations? When it is deemed to be converted into non-eligible forms? Yes, Leela. Registration is cancelled. Yes. Second, yes, Suchita, registration is cancelled. What is the another situation? Modification to the object. Yes, but modification to object, then what? If it modifies the object, it's fine. Legal form, no, Geeta. Modification of object, yes, Khushi, but not applied for fresh registration. Yes, very good. So if it has modified the object, that's not a problem. It has undertaken the modification which does not conform to the conditions of registration and it has not applied for fresh registration. Or if it has applied for fresh registration, but the application has been rejected. What is the other situation? Yes. Renewal pending, fail to apply for reapproval. Yes, Ruchita, very good. Yes, Khushi. So if it has failed to make an application for re-registration, for renewal of approval, for final approval, if its provisional approval has expired. So in these cases, it will be deemed that it has converted itself into a non-eligible trust. Very good. Any question, any doubt? Yes? Yes or no? Any questions, any doubt? Okay. Is this clear, everybody? 14 days from the end of the free. Yes, very good, Ruchita. Yes, that exit tax is applicable within 14 days. That's right. Okay? Yes. Any doubts, any question? Is this understood regarding the trust? So these have been the changes in the or the amendments with respect to the trust. Yes? So you have to, see, make it clear that what are the amendments which are there for each particular chapter. This is how you should be remembering all the provision. It should not happen that, you are not revising it properly because the amendments can be targeted easily in the examination. So you have to make sure that you remember all the amendments clearly and correctly and use the wordings properly. Don't use the short forms of anything. It can happen that you may just say, okay, the registration is cancelled, but you have to write properly what the particular provision says, converting itself to a non-eligible form. So then you have to write accordingly that when it is deemed to be converted into non-eligible forms. Are we clear? Okay, any question, any doubt till now? Okay, fine. Next amendment, what is there in terms of section 16? What is the amendment under? Yes, Suchita, model test papers are good for practice, for sure. What is the amendment in section 16? Yes. What is the amendment in section 16? Yes, very good, Leela. Very good, Geeta. Yes. If you do not opt out of 115 BAC, what is the standard deduction that you get? 75,000. And if you opt out of 115 BAC, what is the standard deduction that you get? 50,000. So if you go under the default tax regime, the standard deduction is 75,000. If you go as per the normal tax regime, then the standard deduction in the salary is 50,000. Be very careful. Then no other amendment from 17 to 27. So there's no other amendment in salary. There is no other amendment in income from house property. Fine. For charitable trust also, all the amendments that were there we have covered. Coming to the head of PGBP. What is the first amendment in section 28? What is the amendment in 28? Can anybody tell me? There's one amendment in 28. Yes. Yes, students, faster. What is the amendment in section 28? In the charging section itself of PGBP. E, no, Leela, income from residential house, always IFOS, no. Geeta, that is in 115 BAC. IFHP let out property and self-occupied. That is no. Yes, Geeta. IFHP, if commercial, no. Commercial, IFHP, no, 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 Leela. All of you are mistaken. What is the amendment? The amendment is that in case if your business is to let out the residential house, if the business is to let out the residential house, then the income will always be chargeable under income from house property and not under PGBP. But what if your income is from the letting out of commercial house property? Then in that particular case, where will you consider? Yes, if the income is from the commercial house property, letting out of commercial house property, then where will you consider? PGBP. As per which ruling? Yes. Chennai property. Very good, Geeta.
Playing from Honeybook for PC.
So Chennai Property and Investment Limited Supreme Court ruling, what does it say? It says that where the holding of the properties and earning by letting out of these properties the main object of the company. Then in that particular case, the assessee was engaged in the business of renting out and earning the rental income, and this is taxable under the head business income. So the Chennai property ruling is applicable in respect of letting out of commercial property. So if it's a business to let out the commercial property and earn the rental income, PGBP. But for residential property, even if it is your business to let out the residential property and earn rental income, then in that case, it will be still IFHP. Now, tell me one thing, this principle is applicable specifically in the context of which entities? It is applicable for all the entities, but where more you can, find this principle? We have discussed this also. Let me see who answers. Yes. Which entities particularly deal in the business of immobile property? Estate construction? No, Geeta. I'm asking about entities. We have discussed. Yes, real estate entity. What is it called, Ruchita? What is it called? Real estate entity, you are right. Yes, let me see who answers. Yes, students, we have done, some days back only. At least someone should answer. You will specifically see this principle in one kind of trust. I'm giving you a hint also, which does the business of renting of real estates. Business trust. Very good, Geeta. Yes, Suchita. REIT. Yes. So in the case of REIT, if the question is asked in the hands of the shareholder or the unit holder, it will be characterized in the same way it is characterized in the hands of REIT. So if it is renting of Residential property, it will be IFHP even in the hands of unit holder. And if it is renting of the commercial property, it will be under PGPP even in the case of unit holder, because in the case of renting income, who pays the tax? The unit holder. It is exempt in the hands of the REIT. Yes or no? Yes? Is this clear? Okay. Now tell me, what is the amendment with respect to the contribution to the pension scheme, the employer's contribution to the pension scheme under 36(1)(4)(a) to claim the deduction? What is the amendment? Yes, Leela. Yes, Geeta. 14% of salary. So 36(1)(4)(a) provides the deduction for the employer contribution to the pension scheme. So here the deduction would be 14% of the salary. Yes or no? The deduction will be 14% of the salary. Yes? Okay? Fine. Then what is the amendment in section 37? Yes, what is the amendment in section 37? Very small amendment. Yes. So section 37 provides that expenditure incurred by the assessee for any purpose which is an offense or which is prohibited by law will not be allowed as deduction. Right? So for that purpose, what are the expenditure which are incurred by the assessee which is in the nature of offense or which is prohibited by law? So if the expenses for any purpose which is an offense under any law for the time being in force in India or outside India, or which is prohibited in India or outside India. So it will cover both any offense in India or outside India, or any prohibition in India or outside India, both. It's not that if you have incurred the expense which is allowed in India but prohibited in US, even that will not be allowed. For providing any benefit or perquisite, whether or not carrying on a business or exercising a profession to a person, an acceptance of such benefit or perquisite by such person is in the violation of any law, rule, regulation or guidelines for the time being in force. What is covered here? Which kind of expenses is covered over here? Not revenue, Ruchita. Which kind of expense is covered over here? Free samples. Yes, free samples to whom, Leela? Yes. Free samples to whom? To medical professionals. By the which companies? To doctors, yes, Geeta, but by which companies? Yes, by which company? Pharmaceutical company. Very good, Geeta. So pharmaceutical companies gifting freebies to doctors is clearly prohibited under the Indian Medical Council regulation. The doctors or medical practitioners are forbidden from accepting such freebies. So therefore, if pharma company gives the freebies to the doctors, it is prohibited by law and will not be allowed as a deduction under 37(1). Okay, so this is covered over here. to compound any offense under any law for the time being in force, either in India or outside India. Or this is the amendment to settle the proceedings initiated in relation to contravention under the law as may be notified by the central government. So to settle any proceedings, if you pay the amount, that is disallowed as the expenses. Are we clear? Okay. Then what is the amendment with respect to the remuneration of the partnership firm? Yes. How is the remuneration allowed to the partnership firm? What are the conditions for claiming the remuneration? What are the conditions for claiming the remuneration? Yes, faster. Yes, Suchita. Yes, Geeta. Yes, Samyathan. Yes, correct. But what are the conditions for claiming the remuneration? Can anybody tell me what are the conditions?
It should be as per the partnership deed and not
Yes,
belongs to the prior to the date of deed
very good.
and must be to the whole time partner,
Very
active
good.
partner.
Yes, yes, very good. So it must be first of all given to a working partner. Can it be given to a company? Can it be given to a company? No. Why, Geeta? Why it can't be given to a company? Yes. Why it can't be given to a company?
Company
Must be a
cannot be a partner.
correct. A working partner is an individual who is engaged in conducting the affairs. So, and other than individual, it cannot be a working partner. So, remuneration should be to a working partner, not to a non-working partner, should be authorized by the deed specifically, and must not relate to a period prior to the partnership deed. And what is the limit of remuneration? On the first 6 lakh of book profit, or in the case of loss, 3 lakh or 90% of book profit, whichever is higher. On the balance book profit, 60%. What is the meaning of book profit? What is the meaning of book profit? How do you compute the book profit?
It is before salary and interest
Correct.
and after considering accumulated depreciation, but
Unabsorbed depreciation. Do not use the word accumulated. Use the word unabsorbed depreciation. Okay. But not considering the brought forward business loss. Are we clear? Yes. Okay. Okay. So these are the amendments with respect to the chapter of PGBP. Now let us move to capital gain. Under capital gain, first we discussed the period of holding. Yes, that is an amendment. Secondly, with respect to the buyback, we discussed now it is no more exempt and the cost of acquisition will be allowed as the loss. In respect of gift, what is the amendment? In respect of gift, what is the amendment? Yes. There is one amendment in respect of gift. So any transfer by an individual or HUF under a gift is not regarded as transfer. Yes, Neera, very good. Only individual and HUF, if they are giving a gift or transferring under a will or under an irrevocable trust, it is an exempt transfer. But if you transfer, if a company gives the gift or other than individual HUF gives a gift, that is not regarded as a exempt transfer. Are we clear? So this is an amendment which has been there. So only a gift by individual or HUF is regarded as exempt transfer. Okay. Then what is the amendment in section 48? What is the amendment in section 48? Faster. Yes, amendment in 48. Very simple. Indexation not allowed. Yes, Geeta. Ruchita, 20% tax with indexation? No. Indexation is not allowed afterwards. So under 48, the amendment has been introduced. Earlier, the indexation was allowed under the second proviso to section 48. Now the indexation will no more be allowed. The indexation will no more be allowed. But tell me one thing in respect of the immovable property. What is the amendment? So indexation will not be allowed after 23rd July. Okay. Before 23rd July, there was indexation. Yes, Suchita, if the transfer is after 23rd July 2024, then the indexation will not be allowed. So LTCG on the transfer taking place before 23rd July, the indexation will be allowed. So you have to see in the question whether the transfer is before 23rd July or after 23rd July. If it is after 23rd, no indexation. If it is before 23rd, there will be an indexation. Okay. Yes or no? However, indexation is not applicable in respect of which assets? Even before 23rd July, listed equity share on which STT has been paid. Listed units of equity oriented fund. Yes? In these cases, indexation is not applicable. Depreciable assets, specified mutual fund or market linked debentures, bonds or debentures. In these cases, even before 23rd July, indexation is not applicable. Okay? What is the amendment in respect of land and building? We'll come to the tax rates. What is the amendment in respect of land and building? Yes, Kita, resident individual and HUF, it will given if it is beneficial. What will be given to resident individual or HUF, Geeta? Indexation, very good. So in case of a resident individual or HUF, when you compute the tax on LTCG, on transfer of land or building or both, they can take the indexation benefit while computing the tax. This is only for computing the tax. Remember that. So when you compute the LTCG, you will compute without taking the indexation if the transfer is after 23rd July. However, for a resident individual or HUF, only to compute the tax, you will compare the tax with indexation, which will be 20%. Or 12.5% without indexation. However, if you have a loss, if you have a long-term capital loss, then it will be computed without indexation. So the amendment has been in section 112 and not under 48. This is just to compute the tax. Or if you want to claim 54 EC, you will you will consider the exemption for 54 or 54EC without considering the indexation. Please do not make this mistake in exam. So this benefit is only to compute the tax on LTCG under 112. Are we clear? Yes or no? Is this clear, students? Okay? Fine. Now, what are the changes in the tax rate? What is the first of all tax rate for the short-term capital gain under 111A? What is covered under 111A? Yes, Suchita, this is only for land or building. Yes. Yes, Geeta, very good. So, for short-term capital gain under 111A in respect of equity share, unit of equity oriented fund, or a unit of business trust, which is listed and on which STT has been paid at the time of sale or purchase, sale and purchase. So before 23rd July, the tax rate was 15%. And after 23rd July, yes, Suchita, it is going to be 20%. What is with the long-term capital gain under 112? So in case of the unlisted securities or shares of a private company before 23rd July, for residents, it is 20% with indexation. After 23rd July, it is 12.5% without indexation. Okay, after 23rd July, it will be 12.5% without indexation. And for non-resident, it was before 10% without the indexation and foreign currency fluctuation. And after 23rd July, for even the non-residents, it will be 12.5% without indexation and without foreign exchange fluctuation benefit. So who get the foreign exchange fluctuation benefit therefore, students? Who get the foreign exchange fluctuation benefit? Sorry, Jacob, I'll not be able to answer this because I've not looked at the question itself. Who gets the foreign exchange fluctuation benefit? NR Indians? No. Not NR Indians. Any non-resident gets it. Jacob, not just FII, any non-resident will get it. FIIs will in fact not get it, Jacob. Non-residents will get it. But which kind of asset? What is the asset? Listed shares on which STT has not been paid. Are we getting this? And which are not covered by the central government notification. On that only you will get the foreign exchange fluctuation benefit, and the non-resident Indians will also get it. Yes, Geeta. Okay. What was the tax rate for the listed securities on which the STT is not paid? It was earlier 10% without indexation or 20% with indexation. And for non-resident, it is 10% with the foreign exchange fluctuation benefit. Now it is going to be 12.5% without indexation for the residents, and it will be for non-resident 12.5% with foreign exchange fluctuation benefit. Any other asset, it was 20% with indexation benefit. Now it will be 12.5% without indexation. For individual or HUF who is a resident, they have an option to pay either 12.5% without indexation or 20% with indexation in case of land and building acquired before 23rd July and transferred after 23rd July. Okay. And what is the change in 112A? What is the change in 112A? Yes. Yes, limit. Yes, Leela. So under 112A, before 23rd July, it will be 10% exceeding 1,25,000. Do not consider 1 lakh as limit. It will be 1,25,000 even before 23rd July. After 23rd July, it will be 12.5% on LTCG exceeding 1,25,000, but the total limit will remain 1,25,000 itself. Are we clear? Yes or no? Okay. Then what is the change in 50AA section? What is the change in 50AA? What is 50AA? Yes. 50AA covers the units of specified mutual fund, market linked debenture, unlisted bonds or debenture transferred, redeemed after 23rd July. Yes, Suchita, not only just market linked, but units of specified mutual fund, unlisted bond or unlisted debentures transferred. What is a specified mutual fund? Yes, what is a specified mutual fund? What is a specified mutual fund, students? Which invest not more than 35% of its proceeds in equity shares of domestic companies. Not more than 35%. That is a specified mutual fund. Are we getting this? And what is a market linked debenture? Which has an underlying principal component in the form of debt security and where the returns are linked to the market returns. Okay. So that is the coverage of this, and these will be deemed to be the short-term capital gains. The transfer will be deemed to be a short-term capital transfer of a short-term capital asset, and in this way the capital gain will be computed. Are we clear? What are therefore equity oriented funds? What are the equity oriented funds? Yes. Which invest more than 90% in the listed shares. Okay. So that is the difference between the 35% specified funds and the equity oriented fund. Equity oriented funds are considered under 112A and 111. Fine, students. Please be careful about this. Okay. Yes, any questions, any doubt? Fine. Okay. Yes or no? Okay, we have discussed the changes in the income from other sources. Like for example, interest will not be allowed as a deduction against the buyback, which is considered as a dividend. Okay, buyback, which is considered as dividend, again that you will not allow even the deduction of the interest expense. You will only allow it against the all other dividend income other than the buyback of shares. Okay, in case of family pension, what is the deduction which is allowed? In case of a family pension considered under income from other sources, you get deduction under 57. What is that which you allow? What is the deduction that you allow? Yes, Geeta, very good. It is 1/3, 33 1/3 or 15,000, whichever is less. Yes, and in case of 115 BAC now, you will get 25,000. So if you go for the 115 BAC, then it will be 25,000. Otherwise, in case of normal tax regime, it will be 15,000. Are we clear? So this has been an amendment in IFOS. Yes or no? Any questions, any doubt? What is the amendment in ATCCD? What is the amendment in ATCCD? Yes, Geeta, very good. Yes. So under ATCCD, maturity proceeds of LIC is taxable. Yes, if it is more than 5 lakh, and if it doesn't, the premium is basically more than the limit which is there, then you charge it under income from other sources, Jacob. Yes, Leela, very good. Under ATCCD, in that particular case, if you go as per the normal tax regime, the employer's contribution which is there is given up to 10%. But in case of the 115 BAC, it will be 14%. So in case of 115 BAC 1A, you will get 14%. Otherwise, it is 10%, the employer contribution. And this deduction will be available under the both the regimes. Clear? Okay. So that is the only change in the amendment in the Chapter 6A deduction. Then what is the amendment under 115 BAC? Apart from the tax rate, that's it. We have the tax rates getting changed, as I said. So that you will have to remember. Okay, you have to remember the tax rates under 115 BAC. Fine. So these are the major amendments which are applicable. Of course, there are few other amendments in the procedural sections 149, all of those that also you would have covered in the relevant provision. You would have also covered related which attempt, ma'am? This is the attempt for January. Okay. Then there are certain TDS related amendments that you would have covered now in your TDS chapter. There have been change in the limits for different TDS provisions. So you have to remember all of that. Fine. So with this, we'll end the session over here. This completes your revision lectures. All the best for your examination and prepare well. Please do the revision. Please do a lot of practice for your exam. Don't do rough practice. Focus on solving each and every questions. Solve as many question papers as you can. So with this, we'll close the session over here. Thank you so much, students. Done. Right.